I still believe that what money managers and investors will go through is unseen. We have not seen anything like that before.
Hello, I'm Ed D'Agostino from Mauldin Economics, and today I have an important interview for you. Felix Zulauf is one of the most fascinating and visionary macro investors I know. His research is read by the world's most noted professional investors, and today he joins me for what's become something of an annual tradition here at Global Macro Update. Felix speaks with media once per year, and I am fortunate that he carves out time for you and I. Felix and I get into his views on the direction of the U.S. and global economy, stock markets, and bond markets, as well as the potential outcomes of today's global conflicts. At a time when geopolitical tensions are at a multi-decade high, if you are an investor, you're going to want to hear what Felix has to say. Take a minute to subscribe to our channel, and thanks for joining us here at Global Macro Update. Felix, it's always great to see you.
Thank you very much for inviting me.
I've been looking forward to this conversation for months, really, because I have a hard time thinking of another point in my professional career where so many smart people disagree so much and are calling for different things, everything from a market crash and a big, deep recession to no recession, soft landing, smooth sailing. I think one thing that has surprised everybody is just how strong the U.S. economy has been after such a steep rise by the Fed of interest rates. What are your thoughts on that? Is the economy really as resilient as it seems, or have we just not seen the lag effect of these steep increases in interest rates?
It's a good question. I also thought that at this time of the year, we would see the weakness coming to the surface in the economy. I do not expect or never expected a deep recession, but a shallow one in terms of magnitude to the downside. And that's still my forecast. I think the rise in interest rates and the sharp rise in interest rates hurt certain sectors in the economy, which we already see: construction, housing, automobiles to some degree. And you see also in credit card delinquencies, you have the sharpest increase in year-over-year rate of change, I think in 20 years or in 30, even in 30 years. It's still at the low level, but it's moving in the wrong direction or in the right direction if you forecast a softer economy. I think the rise in interest rates will be felt over time because refinancing is coming on with a lagged impact. And as that happens, I think you will see that the consumer will eventually slow down. I do not believe it will be a deep recession because the inventory situation in the US is not extreme. So I do not see a deep dive or anything like that. My hunch, however, is that there will be a recession in 24 or a weaker economy in 24 with declining corporate profits. We will feel the tightening that we have seen before. We will feel the impact of the inverse yield curve and all kind of that. I think the Fed made a change in March of this year when we had the banking crisis. Mm-hmm. And the banking crisis led to the situation that the Fed and other central banks in Europe as well injected liquidity at large quantities into the system. And I think that liquidity, together with the games that the Treasury played with liquidity, with the general account at the Fed, and with the reverse repo on the balance sheet, all of that added more liquidity than one would have expected without knowing that, And therefore, I think those who expected a recession have been wrong because of those reasons. And the repo rates are now down to 1.3 trillion. And in my opinion, There is 1.3 trillion to go. And that means by late Q1, that effect is over. And then it is over for real. So you cannot do it non-core. You cannot repeat that situation. And Janet Yellen tried to prevent the bond market from playing havoc when sort of a fiscal crisis began to appear. And she just didn't issue many bonds and issued everything on the short end of the yield curve. And the money market funds, they got so much money that flowed over from bank deposits into money market funds. They picked up and bought the reverse repos, and now the reverse repos, because of that, are coming down. And so I think you had some special factors relaxing or reliquifying the system, but primarily the financial system more than the real economic system. And that extended everything. But my hunch still is that we'll have a weaker economy in 24, and we'll have weaker corporate profits in 24, and the market going higher first will go lower afterwards.
One of the things that surprised me is we had Silicon Valley Bank, huge bank, for assets, failed. Like you said, Treasury, the Fed, they moved very quickly. Nothing else happened. And there's really, there hasn't been that proverbial other shoe dropping. Were you expecting something else to break, or do you think something else might break soon?
It's actually the first time that interest rates or bond yields seem to have peaked for the cycle without an accompanying effect, like a market crash, a recession, a big bankruptcy case, or anything like that. So maybe this time is different, but those are dangerous words. My hunch is that bond yields will go lower first. Very short term, they are bouncing. And then I think they go lower, maybe to 370 or so. My technical work pointed to lower bond yields. But my hunch is that something is not the way it should be. And therefore, we could have another spike in bond yields starting sometimes in Q1 into the middle of the year. And maybe at that time, something breaks. You know, my technical work is calling for this decline, which could be about 370, and then we could go up 200 basis points. The whole magnitude for the cycle on the downside, I think, could be to about 3% plus minus 25 basis points, but something is not the right way. And what I saw is the bond market bulls are now in charge, and the consensus on soft landing is extreme. And when forecasts and experts agree to such an extreme degree, then something else is usually going to happen. That's Bob Farrell's rule, and I think he's right on that. And I see that the positioning in the Treasury market is the most extreme ever. JP Morgan did a survey at the Treasury desk among their clients, and their clients have never been as long Treasuries as they are now.
Wow.
In the whole history. So it's the most extreme. Then there was the Global Fund Manager survey by Bank of America. The most attractive asset for the next 12 months, they said, I think 54 or 53% bonds, which is very unusual. Normally it's equities. Equities are only 25 or 29%. So that's another extreme. Then there is an extreme in how many global fund managers believe that long-term bond yields have peaked and go down over the next 12 months. And this number is something like 70% or so, never seen before. It's about twice as high at the extremes in the past 20 years. And when I compare all these numbers to the last extreme that we saw, that was in late '08, early '09, and we had then another 50 or 100 basis points down, and 6 months later, it was higher. So I think the bond market is positioned for a big decline in bond yields. And if the decline only goes to 370 and then goes up again, we are in for trouble. Then we could see a liquidation wave, and then we could see 550, 570 or something like that. And maybe at that time, something will break and we will have the normal yield peak that we see in a cycle, accompanied by a bankruptcy case, a recession, or a market crash, or something like that.
A few months ago, I had a similar conversation with Louis Gave, who you know. Mm-hmm. And Louis and I were talking about the size of the U.S. government debt and how there is a wave of issuance coming from the U.S., from the Treasury. How does that factor in? Because it seems like the market is ignoring this massive amount of supply that's going to be coming.
Well, the market was afraid of it, and that's why yields went up because of that, and buyers held back, and that's why yields rose. But the wave never came because Janet Yellen was financing and funding everything at the short end, almost the whole Treasury government at the short end and not the long end. So she protected the bond market, but this doesn't mean that it won't come. It means that the average maturity on government debt has declined to a level where it could, I'm not sure, but it could even be illegal because there are rules in funding. It could be even illegal, and it would force Janet Yellen next year to issue even more percentage-wise in bonds. And this could contribute to what I said, that there could be a possible spike. I would pick the second quarter for that. And that would give us then the low in the stock market, because if that happens, then bond investors will get burned and equity investors will get burned, both. Because the equity market is trading off the bond market at the present time. The correlation is quite clear.
Even if yields go down, say 200 basis points, right? A lot. There's still a lot of companies out there, at least in the U.S. On the small cap side, I've heard as many as 30 to 40% of the Russell 2000 aren't profitable. So how do these companies continue to exist when they're going to be facing an actual cost of capital for perhaps the first time in their existence?
You're absolutely right, but the market doesn't care about it. The market is focusing on what drives the index, and those are the Magnificent Sevens, and that's another problem I like to focus on very briefly. We have seen extreme concentration in the late 1990s in telecom and technology stocks. Mm-hmm. Those were maybe 50 to 70 stocks. We had seen extreme concentration in the Nifty 50s in the early 1970s. And whenever you see such a tremendous concentration, you are in for trouble sooner or later. What we have now is we have, for the last 15 years, passive investing has become the way to go, and I would say if being a fad, and this is worldwide. And when you look at the world and someone does worldwide indexing, so the world index is 62% US. So 62% of all the money goes to the US. In the US, 30% going to 7 stocks, you see? And the concentration that we have now in the market is much bigger than anything we have ever seen before. So the point is this: if for any reason the market begins to turn down and some people begin selling, these stocks will hurt dramatically because there is nothing else to sell. professional money managers had to be in these stocks to perform. And when you are a professional money manager, you are measured in performance. And if you were not in those 7 stocks, you did underperform. And if you wanted to outperform, you had to go to an overweight of those 7 stocks. So I have recently seen a survey that says the largest US hedge funds have 70% of their positions in 10 stocks. Wow. I'm not sure whether that is right or not, but it is symptomatic of the extreme concentration and one-sidedness in portfolios. So I think for whatever reason, the market will go down, and I expect that sometimes in the Q1, I expect the market to peak, probably at marginal new highs in the indices. Then I think we are in for not just a plain vanilla correction, but for something very serious. And that does not mean that we will see a deep recession or deep economic problems. It just means that an extreme positioning in the market will be balanced again. And that could mean a lot of downside in the indices.
So downside is usually followed by opportunity. What comes after that? What would you be ready to do? What's your crash plan, if you will?
Okay. Well, I think first we go higher to the upper 4,000, 4,900, 4,950 or something like that. And then I think we break below the October lows of last year, which was 3,500. So quite a big decline. And, you rarely have a year when you have an important high and an important low in the same year. We had it in 22, we had it in 20, we had it in 2018, but those are exceptions. If you go further back, it was 1987, then it was, I think, 1962, 1937. So it does not occur very often. And I think we will then have a high in the first half of the year, probably in Q1, and then a low in summer. And if I'm right, and we have that decline in asset prices, it affects the consumer. Lower asset prices affects the consumer's balance sheet, and he may be more reluctant to spend. And we will have a shallow economy, a weakish economy, and we will have geopolitical problems on top of that, and all that, and maybe even the spike in the bond yields for the reasons explained. If you get that, then you get the authorities to stimulate, and then they will become aggressive in stimulating, and inflation rates will be 2 to 3% or something like that by summer 24. And then they stimulate, and that should really trigger the next upcycle. And then we go higher, and I expect it to go to 6,000 or 7,000 on the S&P. And it will be a tremendous run. I said last time we spoke, Ed, I said, this decade is the decade of the roller coasters.
Yes.
And I still believe that. I still believe that what money managers and investors will go through in coming years is unseen. We have not seen anything like that before, with the big swings in magnitude on both sides of the market. The long-term bull market is not, the secular bull market is not dead yet. I think we have higher highs ahead in 25. Maybe even early 26, and then I think it will crash because if they stimulate, it's not only good for equity prices, it's also positive and bullish for commodity prices, and commodity prices then go up. We have the second big up leg in the secular bull market in commodities. And that means that we are probably dealing with over 10% inflation in 26 or so, I would say. And oil prices near 200. If we have if we have the war escalating eventually in the Middle East, which is a big risk. If Iran, for whatever reason, and we could talk about this if we have time, if Iran gets attacked, they will close the Straits of Hormuz. Mm-hmm. And if they do that, then you take out 25% of global supply of oil on a daily basis. And then you have $400 oil as a spike. That would melt our system. So those are the risks we are dealing with. The geopolitical situation is extremely fragile. I recently listened to one of the best contemporary historians, Neil Ferguson, and he had changed. 6 months before I heard him, he was more moderate. And the last time, that was 2 months ago, I met him in Zurich in a small group. I was surprised how much he sounded like what I tell my subscribers, And he said the geopolitical risk is underestimated everywhere. It is a dangerous place out there, and we do not have any diplomats that could fix the problem. So that's the situation we are dealing with. Usually, geopolitics or politics does not affect the market for very long. If something happens, it's a short-term affair. However, if geopolitics or politics change the secular trend of the economic framework, then it affects markets. And I think that's what we are seeing. The unipolar world order that has been very US-centric, with the US as the major hegemon, that is over. That's gone.
I agree.
And we have now a transition period, which I would call disorder, and the world has to find a new order, which will likely be a multipolar order. And if we cannot achieve that through diplomacy, we have to go through wars. And when the top dog is weakened or considered to be weakened, you have all sorts of conflicts popping up to the surface. Armenia, Serbia, Guyana, Gaza, what have you. And I think this will continue because the BRICS are considering the US as weak. And the US is not in a strong position. I quote again a famous historian who said, the US needs another 10 years to be ready for war. So the US is not ready for war. And that creates risks, much higher risks than we assume. So this makes for a very volatile world, very volatile markets. And the biggest assets investors should have is an open mind and flexibility, because the moves will be quite dramatic. I think the short-term moves, the sell-offs that we are seeing now, could go down to 4,300, and then we could go up to 4,900. Those are big moves.
Huge.
And then down to the low 3,000.
It's interesting you mentioned Guyana, because you're the first person outside of another geopolitical expert, Renee Aninow, who you probably run into at the Strategic Investment Conference. He's the only other person that has mentioned that conflict. Most investors are only hearing and seeing the big stories in the news, so Ukraine and the Middle East. And there's so much in the geopolitical sphere happening below the surface, quietly, that we being the U.S., just don't seem to have a handle on. So Guyana, if I understand it correctly, is basically Venezuela trying to extend its borders to grab the natural resources of Guyana. And Guyana, what can they do about it?
I cover geopolitics a lot in my reports to subscribers. And I said at the very beginning of the conflict in Ukraine that Ukraine will lose that war. And now it's decided already. That war is decided. It's lost for the West. We can talk about how it will end, etc. I have certain ideas. but it's lost. And the West will not contribute a lot more because it's a black hole. You sink too much money. Israel, Middle East is a very difficult situation. Always has been. Always has been. If you go back in history to the Ottoman Empire, etc. And I think the Arab nations, Shiites as well as Sunnis, have agreed, and they are in agreement how to behave. They are pushing for a second nation, for a two-state solution, which is almost impossible when you understand how the West Bank looks like today. And I think they are on one line. They are in agreement. And, you know, the Saudis and the Iranians, they have not been very good friends. The Sunnis and the Shiites, they were like the Catholics and the Protestants in the old days.
Sure.
But they are together, and I think this is the power broker China who brought them together. So it's not the power broker in the Middle East is now China. It's not the US anymore. And it's a very difficult situation for Israel. If the Gaza operation is terminated and they turn towards Hezbollah in the north and attack in Syria, then that would call for Russia to participate, because Russia and Syria have agreements, military agreements. So that would pull Russia in. If in Syria has also contracts with Iran, so it would pull Iran in. If Iran is there, then of course Israel is on the other side, and then it pulls the US in. So this is a very dangerous situation. And my fear is that Netanyahu, being in difficulties in no war times because he's prosecuted for corruption, he's interested in extending the war for selfish reasons. So I think this is a very delicate and difficult situation we should monitor as investors.
Felix, I don't want to take up too much of your time, but you mentioned the power broker being China. We can't end the conversation without having at least a brief conversation about China. You mentioned earlier that you feel like commodity prices will eventually go up, and I want to press you on that a little bit, because I have a hard time seeing how commodity prices go up when China's economy is where it's at today. My understanding is it's struggling. It's low growth. They have their own serious issues with real estate. I know that's not the entire economy, but Xi seems to be focused on other areas right now. How do you reconcile the two, or kind of a weak economy for China and yet a commodity growth?
It's a very good question, Ed. First of all, if the West expects China to stimulate like in the old days and create high growth, they will be disappointed. That will not materialize. China is in a structural problem. They have to deflate their real estate sector, and that will cost a lot of money. And eventually they have to monetize it. And if you monetize something like that, your currency goes down. So they will proceed very carefully, and it will be a drawn-out affair, I would say at least 10 years. That means that China is out as a factor to bring high growth to the world economy. You know, China has been the driver for many years. That's over. That game is over. It's past. The world economy is actually growing in real terms at 1.5%. And 1.5% in the past 70 years has always been a recession. So the world economy is actually in a recession-like situation. I do not expect China to increase demand for commodities in a major way. What I do expect, however, is that the commodity suppliers will restrain supply. So I expect the rise in commodity prices not due to strong demand, but due to weak supply.
Okay.
And all you need is a certain normalization of demand. and restrain supply. Keep in mind that 75% of the commodities in today's world are controlled by the BRICS. And in the power struggle and conflict between the autocracies and the democracies, the BRICS are more autocracies, and they will use that weapon of commodities in the conflict to weaken the other side. I think that is the solution to your question.
So when I put all of this together, that part of the world that I'm most concerned about, I think, is Europe. I mean, it seems like Europe's in a very, very precarious situation.
Europe is the big loser. Europe is the big loser. And you have to understand, from a geopolitical point of view, the US wanted to break Europe from Asia and Russia. If you look at the Eurasian continental plate, it's 4.5 billion people, okay? That's 10 times as large as NAFTA. And the trade increased dramatically. Germany's trade with China is bigger than Germany's trade with the US.
Wow.
And the US got concerned that if these guys integrate more and more, and there is a railroad, a direct railroad for cargo from Beijing to Germany, you see. So if these guys integrate more and more, we lose our influence on Europe. And that's why they had to break that. And Ukraine was the breaking point, because by provoking Russia to attack, which was the plan, I mean, the regime change in 2014 was orchestrated by the US. And by forcing the Europeans into sanctions against Russia, it was the first step in the break. And they are trying to force Europe into sanction against China, which will not work, because that would be horrible for Europe. So it's a different setup. Europe has virtually no commodities, very few, very little in commodities. So we are dependent on the Middle East. And if I were the leader of the European nations, or even one of the bigger economies, I would travel to the Middle East and make sure that I get all the stuff I need for our economies, back and forth. They are sitting tight. They are flying to climate conferences and such things. They do not get it, and how weak a position Europe is. And I do not see any change. I think Europe is the biggest loser of all of that, and that will be seen in the currency long term.
Wow. Is there anything that I didn't ask you that I should have?
Maybe gold. Maybe gold. I'm constructive on gold, but I think the recent rise was for the wrong reasons. It was geopolitics. And actually gold rose together with real interest rates, which has virtually never happened before. And probably means that gold is very short-term, not sustainable, needs a rest. Eventually it will go higher. I don't see a lot of downside, and it will go higher. I think next year we will see 2,500 or so.
And do you look at gold really as a currency hedge more than anything else, or do you look at it as an inflation hedge?
I think in the longer term, particularly in the second half of the 20s, what I described about rising interest rates, rising inflation, rising interest rates, and then a crisis. And in that crisis, I think our governments will underwrite the economies. Unlike in the 1930s, when they had a stable gold-anchored currency, and they let the economy down, I think next time they will underwrite the economy and let the currencies go down. And then gold takes off in a big way.
Felix, we need to get you to the Strategic Investment Conference. I wish it was sooner. It'll be the end of April this year, and I hope you can go longer and deeper with us at that point.
With pleasure. Thank you very much for having me, Ed. It's always a pleasure speaking to you.
I hope you enjoyed this conversation with Felix Zulauf. By the way, we've got a great month lined up for you here at Global Macro Update. Next week, we speak with former Federal Reserve economist Claudia Sahm, and then we'll hear from our favorite political pollster, Dr. Frank Luntz, for a tour of the U.S. presidential candidates and what he's hearing in the field. Be sure to subscribe to Global Macro Update on our website. Subscribers get a free weekly email with a link to each new video, my additional comments on these interviews, and a full transcript. There's a link in the description below where you can get all the details.